Good morning, everyone. Welcome to the new week and the macro snapshot. We are Monday, June the 16th, 2025, recording this about 7:30 in the morning. Okay, so let's see what's going on. Obviously, the geopolitics, what's happening between Iran and Israel is kind of dominating the headlines. But I think let's just sort of step back a little bit. There's no real sort of data this week apart from the retail sales, which we have tomorrow in the US, which is going to be interesting just to see if the US consumer continues to sort of to spend essentially and keep on supporting the economy. But what we do have in the next couple of days happening now is the G7 meeting happening up in Canada. And that's going to be interesting just to see if anything comes out of. There's a lot of bilateral meetings happening between Trump and a few other countries. And let's see if we get any information or updates on trade deals, especially maybe with the Europeans. Let's see what's happening with the G7. Apart from that, we have quite a few central banks. We have the Swiss National Bank. There's rumors, or not rumors, that expectations that the Swiss National Bank might actually cut down to zero, which hasn't happened for a few years, as their inflation seems to be falling. So we could get a cut down to zero. We also have the Bank of Japan, not a lot expected there, and the BOE, of course, that's expected potentially to be a hold. And naturally, the most important one is the Fed, which we'll look at obviously in a bit more detail maybe tomorrow. But let's see what happens, especially with the dot plots. And obviously, we have the situation with oil and Iran and everything, which we'll look at in a moment. Let's have a look at that. Okay, but before we look at the oil and everything, let's just see what's sort of going on with the Fed and the bonds, just to sort of put everything into context. So what we can see here is that the one I like to look at, I mean, for this upcoming Fed meeting on Wednesday, as you can see here, 0% chance of a hike or a cut, according to the market. That would be an extraordinary sort of shock to the market. And then we have to look out and really just wait. We don't really get much action in terms of expectations until we get out to September. We get a 75% chance of a cut in September. And then the first cut is not really priced until September and then into December. And we're at 1.8 cuts. And you can see that it's been hovering around about the 50 basis points of cuts, which is the 50 here minus 50 here. That represents two full cuts. But as I've been showing you guys over the last few days on this chart, this is the intraday chart for the December pricing for the FOMC. You can see that, if we get sort of a hot jobs number, employment report, and then a softer than expected CPI, then a softer than expected PPI, the market's sort of going up. But basically, it's either side of two cuts, like sort of 45 basis points of cuts, maybe 55 basis points of cuts. Seems to be trading in that sort of 10 basis points of range. But what we have seen is that on a Friday, just with the escalation between Israel and Iran, we can see that the market repriced in a hawkish way. And I think what's important to note here is we were down at about 56 basis points. And as we currently speak, it's about 10 basis points more hawkish or less cuts. So it's sort of minus 46 here. And essentially, the way the market seems to be looking at the situation in the Middle East is of a danger to inflation. This whole idea that, if this sort of becomes a bit more sort of involved, this sort of conflagration, then oil prices might go up, which could potentially sort of be inflationary. And obviously, that would maybe make the Fed pause twice before thinking about cutting. So it's through the lens of the oil price and its potential to spike inflation and the potential for that to slow down global central bank easing, specifically the Fed, which is how the bond market seems to be reacting. So talking about the bond market, let's just have a quick look and see what's going on. So I've got here the 2-year yield, and you can see here that the effective Fed funds rate at the moment, it's about 4.33. But the thing is that the possibility of the Fed hiking, although I was reading some research earlier this morning saying that's a possibility, but I think it's a very, 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 very low possibility at this point. It seems really that the Fed at some point will cut either once or twice this year, or certainly at the beginning of next year. And keep in mind that we have Powell, whose term ends in, I think it's May of next year. And what's quite curious, if you look at the SOFR contracts, is that a lot of the SOFR contracts, so the 3-month contracts, are going out to Powell they've been sort of weakening a little bit, whereas after sort of May, June, when Powell's successor takes over, those SOFR contracts on a relative basis have performed better. And so the idea here is that whoever Trump appoints to be the next chair Fed will actually be under a lot of political pressure to be very, very dovish and to perhaps even be cutting aggressively. So that's something quite interesting. Little bit of tea. Okay, so let's just look at the 2 year here. Like it seems to me that it's trading in a range here. You can see basically it's in a range of about 4.6, 4.05 down to about 3.85. And that's simply going up and down based on sort of economic sort of data, whether we're getting more dovish or hotter kind of data. And I think, though, to be honest, the chances of the 2 year getting above, let's say 405, 406 are relatively low because anything higher than that would essentially say that the chances of the Fed cutting in the next, 12 to 18 months, 24 months are not going to happen, which I think is very, very low probability. So my first sort of thing to be looking at on the 2 year here is that anything which gets up towards about 405, 406, which by the way is also the 200-day EMA, would probably be a pretty good thing to sell the yields here, or basically to buy. A similar kind of situation in the 5 year yield here. Again, just trading in a pretty tight range. That's actually a slightly lower yield here, and it's possibly because institutions need just a little bit of duration. They're not quite comfortable going into the 2 year at this point, looking for a little bit of duration. But again, I think the 2 year, the 5 year, anything which gets up to 4.12, 4.13 would probably be a reasonable buy as well. Now we continue to have sort of inflation concerns, that inflation still remains sticky. There's still and obviously what's happening in Iran and in Israel. This is yet another factor which potentially could be inflationary, and so there's still a concern about the long end of the curve. And added to that is the whole thing that the deficits don't seem to be being discounted or trimmed in any sort of way. Spending still seems to be high. And issuance continues to be high. So it looks as though, the 10 year yield could even, that could potentially rise up to 4.5, which is this kind of purple dotted line. And if you look at the 30 here, you've still got that 5%, which absolutely could happen. And almost it looks from a technical perspective here, one could argue that this was a bull flag, which went up, and then we have another bull flag, and it could also be sort of heading higher. So it seems to me that, like we have a steepening bias is probably the way to be looking at things, because if we have a strong economy with a sticky inflation and continuing deficit spending, that's going to be bad for the long end. And any sign of sort of inflation coming down relatively strongly or relatively well, and the Fed wanting to cut, is going to bring down front end yields. So I think you have to look at this as a sort of as a steepening bias here. And I think that something like the twos, tens here. It would be doubtful if this, I don't really see it getting too much lower than, let's say, 42 basis points here, which is down about the 100-day moving average, also a bit of horizontal support. So I'll be looking at that. If it gets down to about 41, 42 basis points, I think that could be an interesting risk reward in terms of a steepener plays the twos, tens. And if we look at something like the twos, 30s, a little bit more extreme, a similar kind of environment here. You see that it hasn't flattened at all. So notice here how the twos, tens have actually flattened a little bit, whereas the twos, 30s not really that much at all. And if possible, if that got down to about 90 basis points, something like that, that I think again would be interesting for another run up to steepen. Okay, so if we look again, I just want to look at something here just to see the general direction here. So let's keep our eyes on, let's say, a longer term moving average. So you can see here, which is this thick sort of orange line. This is the 200-day EMA here. So if you look at that, you can see on the 2 year yield, and again, I'm just trying to get a sense of the general market sort of thought here. You can see that this 200-day EMA is actually sort of slowly sloping downwards on the 2 year. And that's telling you that the 2 year, the market believes that despite all the problems and the complications and the sticky inflation and whatnot, that inflation will at some point slowly grind down, and and the yields on the 2 year will slowly come down as the Fed gets closer to cutting. But then compare that to, let's say, something like the 10 year, And you can see here the 200-day moving average, again, this thick orange line, you see that's actually gently sloping upwards. If you look at that, and then if you look at something like the 30-year, you can see it's a lot stronger. So the general trend here is in terms of the moving average, like a longer term moving average, is for the long end of the curve to be just sort of slowly moving up in yield, whereas the front end of the curve is slowly moving down. So again, that's telling you like you want to be having a sort of a steepening kind of trading bias. Um, okay, so and again, just to finish off here on the 10-year, one thing I would say, just in terms of the Fed funds, as I said, is at 4.33, which is about round about here. Okay, so this is 4.33, which is also the cost of funding. So general collateral is around about 4.3, 4.32, something like that. And so the point is here that any sort of big sort of institution or pension fund, anyone who wants to be buying the 10-year, they'll have to fund that using the general collateral, which is, as I say, about 4.33. So at a certain point, if this yield dips too much, if this gets too close to the general collateral level or the Fed funds level of around about 4.33, which is down here, it no longer makes sense. You're almost like you have a negative carry, and it no longer makes sense to be a long duration here, along the 10-year. And so my point being is that anytime the 10-year yield gets down towards these levels of Fed funds rate or general collateral, around about 4.32, 4.33, that probably represents basically a sell, in the sense that the yield should go up. So you want to be selling something like ZN, because the cost of funding is simply not worth it. Okay, let's just have a quick look and see what's happening over in Europe. And we can see, let's just say, let's have a look at the 10-year here, the Bund. And you can see here, again, just looking at this 200-day moving average, this thick line down here, you can see that every time we get there, it seems to be bouncing off it, even going back to the beginning of the year. So you see that this 200-day moving average for the yield is quite a big support. It kind of dipped down there, down below about 245, just on the escalation in the Israel-Iran conflict. But you can see already it's sort of moving up here, and it's being rejected. Similar kind of situation if we look at, let's say, the French 10-year. Again, this 200-day moving average is where the market says, okay, that's enough. We need to have a little bit of a yield. And as I've said a few times over in these videos, the real yield in Germany, getting back to Germany, is actually still quite low compared to the US. So this yield probably needs, the nominal yield probably needs to go up a little bit more, just to give investors just something more to something a bit juicier, a bit more of a yield return. Because at this point, at what are we at today? About 2.54, that's only giving you a pickup of about 50 or 60 basis points in terms of real return. One thing I can say, though, just having a look at this, if you look at Italy, just look at that. Italy, actually, the yield much below the 200-day moving average. So quite interesting here that Italy's yields are much lower than either France or Germany, especially on a relative basis here. And if we actually look here at the spread between Italy and Germany, we're actually under 100 basis points, right about 94 basis points, which is very low if you look on, let's say, the last 10 or 15 years or so. And that's essentially saying that investors are relatively happy about the political stability internally in Italy. We had a referenda a couple of weeks ago. There was a very low turnout. So that's basically saying that the populace seems to be relatively sort of happy with what the government's doing. So that's indicating a bit of government, quite strong government stability. And as we see, we're getting a much better pickup. You see the Italian bond here is yielding about 3.5%. Now compare that to Germany, about 2.5. So even though, historically, Italy does give a yield pickup, that's definitely, obviously, there's sort of money going in there at the moment. So that's kind of interesting here, this buy Italy, sell Germany situation. And again, just looking just at the yield curve, similar kind of situation in Germany. I expect the yield curve there, if I can find it here, let's say something like the 2s, 10s. Again, that's flattened a little bit, but I think, if this were to come back down, if possible, that would be quite good if we could get this down. I mean, the perfect situation, if it were to flatten down into the 50s, like around about 50 basis points or 55, that would be quite a nice sort of a potential steepener in Germany. Because again, the ECB has for the moment stopped cutting. So I think the 2-year yield here, the Schatz, if we have a look at it, the 2-year yield is probably just going to sort of not do too much, either not too much upwards and not too much further downwards, probably in a range. And as I say, I think just with the infrastructure spending and the defense spending, there is a possibility for the 10-year yield in Germany to do the heavy lifting and to go up. So the front end shuts won't do too much. And so therefore, I think something like a twos, tens, a steepener, if it just comes down maybe a bit more of an attractive entry point could be interesting, as it also could be for the twos, 30s over in Germany. Okay, so let's continue on. So let's have a quick look at FX. Interesting. So obviously, with the escalation between Israel and Iran, and initially we did get a bit of a pop in the dollar index here, and you can see this is on the Friday. You see here we had a little bit of a pop, and it has ground up a little bit, but still, if we just step back, this is extremely, extremely weak. Now we're actually at a critical point here. It's like a double bottom here along about the 97.88. This seems to be the support, but as you can see, all the moving averages are still in a pretty strong downtrend at this point. Is this technically a little bit oversold? Yes, one could say that. And this is definitely a very key level here. You can see going all the way back to March of 2022. So for sure, this is a key level. But if we get, let's say, weaker data, if we get a Fed which at some point wants to cut, and we still get this sort of lack of policy precision and sort of seriousness in the States, for sure this could break, and then the next level down is probably going to be like 96 or something like that. So it does still seem as though, in general, the dollar is under a bit of pressure, which is not to say, of course, and this is where it gets a bit tricky for short-term traders, which is not to say, of course, that this can't have some kind of technical bounce, up to, 99.2, or, who knows, even to test up towards maybe the 50-day moving average at around about the 100 level also. It also depends on oil. We know that the US is a net exporter these days of oil. So if we have the oil price, which continues to stay elevated or maybe even spikes higher, net, that should be a positive for the US dollar. So there is a possibility, if the cards fall in a certain way, of the US dollar having a short-term spike. But structurally, this does seem to want to sort of stay, even if it doesn't collapse down here, maybe just staying range bound around this sort of levels here of, let's say about 98 up to about 100. And for sure, any sort of dovishness from the Fed or weakening of the economy could cause that to further go down into the 90s, maybe down next level down 90, 96, something like that. And just quickly, if we have a look at the euro, where are we? We'll have a look at the euro on spot here. So euro USD, again, very strong chart. You can see all the moving averages are strong. It was bought at this sort of fib retracement, like this sort of longer term one. And the measured move here, if you go back to this impulse here, the Fibonacci extension does measure a little bit higher, but it was rejected around about this very key level of 115.70 or so. So that's the key level at the moment. But at this point, this does look pretty sort of bullish. I have to say there's nothing at all negative or bearish about this chart. And we do have this key level of about 15, it's about 1540 or so, which is around about here, 1540, 1550 or so. So this could pull back just a little bit back to one of these moving averages. But the reality is, if this pushes higher, then for sure we could go up into maybe the 117s, 118s up here, which would, be a level, if you go back on the chart here, which would be something around about here, 116, and then maybe even pushing up a little bit higher. So it looks as though the euro is definitely still quite strong. Now, just over the last 3 or 4 days, we saw that the Swiss franc has been strong. You see the US dollar actually sort of fell against that, one of the rare currencies that fell against. As I said before, we do have the Swiss National Bank's decision potentially cutting down to 0%. And they're worried. They're getting a little bit worried that the Swiss franc is just getting way too strong. So you see here the Swiss franc strengthening as the US dollar goes down against it here. But we have now got to some sort of support. We bounced off the 80.50 level here. So let's just see if the US dollar maintains a little bit of strength, and we'll talk about that a bit more as we look at the Swiss National Bank decision later in the week. We also have the Bank of Japan. They're expected not to change their policy. We see here that the US dollar has been grinding higher, but I don't even know if we could call this a trend. You can see here on the 20 and the 50 days, those moving averages are starting to go a little bit sideways, although the longer term averages are still pushing downwards here. I think here that the US dollar probably wants to weaken, and so but it'll probably take another catalyst, either some kind of hawkishness coming out of the BOJ, or on the other hand, conversely, some kind of dovishness coming out of the Fed. But that might still be many weeks away, if not, a month or two. But when and if that does happen, for sure, the US dollar JPY that can break these levels here, pretty key 142, and then of course to test this all important level down at 140. Okay, let's have a quick look at commodities. Just with oil breaking out, we did get, the GSG, which just the general kind of fund I like to look at here. If we just bring it up, the general commodities index, and of course that bounced a little bit higher. Basically broke out probably on the back of the oil rather than sort of the broad sort of commodities, because we know commodities basket. But still, this is quite an interesting level now at about 23.20. And you've got to say that with the sort of weakening US dollar and the global economy being, not horrible, and inflation being sticky, it's going to be interesting to see that, this potentially could fall back. But if this does fall back and gets bought on the dip, it might want to gap fill back here to 22.45 or so. It could be interesting because if this can push out, then it's got a lot more room on the upside. But still, we will have to see a decisive break of this trade range here, which has held for, a couple of years now. So really around about 23 bucks is very important. Having a quick look at gold. We all know the reasons. I was reading a report over the weekend that China, the Central Bank of China, is actually buying 3 times as much as it officially reports. So over-the-counter sales, especially in London. So for sure, there's still a lot of central bank sort of buying structurally of gold. But and if we look at all the uptrend lines here, everything's looking very strong, sort of upwards momentum. So can gold break up to 3,500, even up to 4,000 at some point? Absolutely. Definitely central banks, so from especially non-G7 kind of central banks, are diversifying a little bit slowly out of their US dollar reserves and US treasuries. So the structural bit is still there. We still have a bit of sticky inflation, and there's still a bit of geopolitical risk. So I think gold on any kind of pullback is probably a buy. The question is always like to figure out, where exactly is the pullback. But it seems to me that, something like around about this level, 3,250 could be interesting. Maybe the 50-day moving average. Definitely that's something kind of interesting there. Okay, just finally, guys, let's have a quick look at equities. First of all, what I would say is that the VIX, actually, I just wanted to quickly, before I forget about it, just look at EM. So we know that with the sort of weaker dollar, that's a positive for emerging markets in general. If we actually just look at, I think I have EM down here. Yeah. So if we look at EM, you can see that that's actually doing very well. So that's something just to keep an eye on here. If we do get continuing weakness in the US dollar, I mean, obviously, there's a lot of idiosyncratic stories within the EM sort of space, but it looks as though this has broken a key level here, and there's definitely plenty of more room on the upside if that wants to run, if we continue to have a weak dollar. Just looking at the VIX, we did get a little spike on Friday. As you can see here, we got up to about 22-ish, but that subsequently has come down because it does seem as though the situation in the Middle East is how can I say, it's not improving, but it looks as though we haven't yet reached a further stage of escalation. Now, if we look at the ES here, we can see that you see there's a bit of a risk on tone this morning. We also see that in things like the Australian dollar, New Zealand dollar doing well. So there's a bit of a risk on tone this morning, and you can see the equities here is pushing higher, and basically the US equities have said, hey, this doesn't particularly it's not a problem for us necessarily. We see also NASDAQ pushing higher, and if we go across to Europe, just look at some of the European indices. Let's look at, for example, the Euro Stoxx 50. That's also got a little bit of green. So at this point, no particular reason to be negative stocks in the US. It seems that the market has broadly come to terms with some form of sort of tariffs, maybe the 5, 8, 10% kind of range. And as that grinds on, the market will accommodate more and more. We haven't yet we haven't closed yet above this sort of level here of 6,078. But assuming we can get above there, you've got to say that the easiest path forward for equities is probably to retest the highs. And there's nothing really much to say about that. The only thing which I say would be a negative is let's say just going on the cash index, SPX, if we get down of marked here about 58.65, I think it's going to be like a sort of a key level, this sort of level down here, 58, 60, something like that. But until and unless on the cash here, we close below that. There's no reason technically to be negative on the equities. If we get a close below that level, you potentially could say there could be some upside, sort of some opening to the upside. But it looks as though we're not there. And as you can see, the moving averages are all sort of pointing upwards. Okay, let's just finish off on a little bit of situation of oil. I guess we've all been following the news. What I would say is that it's interesting. You look on the daily charts here. Obviously, on the escalation, we had a big spike up, but that came down on the Friday afternoon. And then you can see that on this extra escalation over the weekend, you can see that we gapped up at the 6 p.m. Opening last night. We got all the way up to $77, but it's been a pretty aggressive sell-off since then. You can see that we've come down about $5 or 7% since the 6 p.m. futures open last night. And that's because, some of the news coming out over the weekend was saying that there was a couple of refineries had been hit. And of course, that's the big issue. The big issue really is going to be whether the Straits of Hormuz, where about 20% of oil, not only Iranian oil, but also Iraqi and Saudi and Gulf oil all flows through there. But that would be a huge, huge problem for Iran itself for various reasons I won't go into. So I think that's a very, very low probability. For sure, if for whatever reason the Gulf of the Straits of Hormuz are closed by the Iranians or proves to be closed, of course, oil could spike another $5 or $10 in a heartbeat. The second thing as well is that most of the Iranian sort of storage for oil and refining is on Karg Island, which I think is Kharg, Karg Island. And essentially that has not been touched at all or targeted by the Israelis. And although for sure there's a lot of nasty tit for tat stuff, and we're seeing a lot of flames and whatnot, it does seem that the Israelis at this point are not specifically targeting the oil industry, and on that news. That's why this morning we've seen that come down. So if that's the case, I'm just wondering at that point, but there's still a lot of tension. You can see that oil volatility is still pretty high. We can have a look there. You see that oil vol, this is OVX, which is oil volatility. And you can see that volatility is very high. So let's see where that opens up today. So for sure, volatility is going to be high. There's always, it just takes one bomb in the wrong place for oil to spike up another $10. That's absolutely a possibility. So it's dangerous to be shorting at this point. But it seems, if you look at all the time spreads, they've come back a little bit as well. And a lot of that's going to be, let's see what the headlines are today. We already had Trump tweeting saying that, he was going to maybe organize a deal, but I think we ignore all that. I think my personal view, but who cares what I say, but my personal view is that the Israelis are quite serious this time of using this Iranian period of weakness to actually deal as close as possible to a knockout punch to the Iranian sort of ability to, produce sort of, nuclear sort of weapons or sort of enrich uranium. So I think there's still a little bit more to go in this campaign. Let's see if outside pressures come to bear on the Israelis. And most importantly, just in terms of markets, whether other players are dragged in, whether the US is dragged in, whether Russia's dragged in, whether the Saudis are dragged in, that all would throw fuel on the fire. And of course, specifically for the oil market, we have to keep an eye on headlines as to whether any of the important Iranian refinery or production facilities are hit. And secondly, whether any of the transit points for all of that oil coming through the Straits of Hormuz are affected. And so far, it doesn't look that way. If we just have a quick look, just look on the Bloomberg terminal here. Just give me a second, bring up a couple of these um, oil numbers here. So I'm just going to go into oil. Okay, so if we look at the curve just for CL anyway. Now, if we can look at, let's say, a day ago, I'm not sure if it's going to show it. Let's just have a look. So the live data, yeah, so the live data is the white one. So you can see that, the prices have fallen down. Obviously, compared to a week ago, there has been, a significant sort of steepening at the front of the curve in the prices. But just compare the white compared to a day ago, the blue, sorry, there's a truck here. You can see that it's come down a little bit. And if we actually also just have a look at, let's say, I want to look at the spreads here, let's say CL1 to CL6, just see if that's reflected. It might be a little bit too short term here. Let's just see, just wait till that comes up. Right. So you can see here on a 60-minute chart, you can see how that spiked. This is the spread between the front contract, the prompt contract, and CL6, the sixth contract. And you can see that that spiked up obviously pretty aggressively at the end of last week. But you can see here just in the morning, maybe if I put this even on a 15-minute chart, just to really bring it in a little bit more. Just give me a second. You can see, right. So you can see here, this is again the spread here. You can see that it's starting to it's starting just to come off a little bit, although it's still at quite elevated levels. So definitely there's still a bit of sort of tension, and it's going to be headline driven. But the longer we don't get headlines, and if we get any sort of sign that the rhetoric is calming down, and if we get any sign that there's starting to be some diplomatic effort, and if we get signs that the Israelis are saying, hey, we're not specifically targeting the oil infrastructure and the transit points, well, then I think oil can come down because the oil market structurally is still relatively weak. Okay, I'll leave it there, guys. I've already spoken too much. Have a great week, and we'll keep in the conversation going. Thank you.